You are now tuned into the smooth sounds of TMG. I'm your host, the Marcus Garrett. What it is, folks, and you know what this is, the disclaimers and disclosures. The Marcus Garrett Show is for informational and entertainment purposes only. We do not offer investment advice, and you should not constitute any conversations on this show as investment advice, legal, tax, or financial advice. You alone assume the sole responsibility for fully evaluating the merits and risks associated with the opinions we provide. When in doubt, please consult with a certified financial planner, legal, professional tax advisor, or other who can provide expert advice on your unique situation. Now back to the show. Recording live from the Nephi podcast stage in Austin, Texas at FinCon 21, hashtag FinCon 21. This is the Marcus Garrett Show, where we have entertaining conversations with your favorite influencers and entrepreneurs about life after death. I'm here with Jeremy Schneider of the Ultimate Personal Finance Club. Actually, it's at Personal Finance Club. It's just ultimate to me because I'm always favoriting his posts, keeping up with the comments, and I don't know how you do it, actually. So that's where I want to start. I see you often in the rent versus own debate, and I know controversy sells. So what's your beef with home ownership?
Well, thank you for having me. And yes, I like starting off with the controversy. And yeah, my thesis on this is basically buying a home is not a good investment. It's a good place to live. It can potentially be a better, way to spend money than rent. You could maybe spend less, but I think a lot of people are kind of bought into this myth that home ownership is the best investment you'll ever make. And it's not true. On average, if you look at the average appreciation in a home price, the average cost of a mortgage, the average taxes and maintenance and realtor fees and insurance, you lose money on your home. You lose money on rent too, but they both are expenses. And so when it's rent versus buy, I think that's kind of like this false choice you have to make. One isn't better than the other. What's really better is renting or buying more modestly. So if you put all of your money into your primary home, you're going to end up in a place where when you're 60, you haven't actually built any real wealth other than like slowly paying down the mortgage in this forced savings account of your home. And then, you can't retire early. You'd have to sell your home to like realize any of that wealth. And so yeah, I say rent or buy, whatever you want, but do so modestly and invest outside of your home.
And speaking of retire early, I appreciate you for saying that. You retired at age 36, and now that we've got the listeners' attention, I want to talk about both your platform and your course. You've got a great platform, and I'm going to have to ask you, maybe even offline, how you do all of that if you do it all yourself. But great meme account. I've learned you actually helped me open an investment account with Vanguard. And It's like 5 slides. I've been putting it off for like 2 years because I built up, like many people, this story in my head, like, I got to talk to a financial planner. It's going to be so complicated. And one day you were like, how to open an investment account with Vanguard. I'll get that in the show notes for the people who want to do it. It took me like 15 minutes. The hardest part was I had to find a checkbook for my routing number.
Yeah.
And ultimately I was able to find it in the app. And so I made an excuse for 2 years, and so I appreciate you for doing that. And I looked in there yesterday. I dropped $1,000 in there just to get it up and running. I put it off for 2 years, and it's like $1,100 now, which is pretty good because it's been open for about 9 months. And I actually forgot the password, so that's how active I am in there. And I want to get to the point where the business allocates money to it each month, $500 a month, which we'll get to, which is another meme that you have.
Nice.
So your course and platform is how to build wealth by investing in index funds. So why index funds?
That's a great story. Thanks for opening that account and saying it, because the world of investing is a scary place the first time you dip your toe in it. If you walk in and you hear about investing, there's images of people on the traders on the floor of the stock exchange frantically waving pieces of paper, and Bitcoin and oil futures and pork bellies and day Forex and day trading. It's crazy, but at the end of the day, almost all that is total nonsense. If you read all the classic books on investing and really understand how to build wealth in this world, it's by buying the companies of the world that generate the profits of the world and owning them so that you get your share of those companies. And then, the question is okay, well, which companies to buy? And the answer ends up, after some research, it ends up being pretty simple, which is, the market is efficient, which means all the sum total of human knowledge is priced into each and every stock in the stock market. And so a single person, me, anyone, professionals can't look at the stock market and decide which one to pick. So enter the index fund. It's just a simple, low-cost way to buy all the stocks, which on first first glance, the first time you're hearing it, sounds a little crazy. But when you own all the stocks, you've guaranteed yourself your fair share of all market growth. Like every single worker from the janitors to the CEOs is working to make you rich, and as those companies grow in profit, those profits are funneled back to you. And so what you did by opening a Vanguard account, putting it into like a low-cost index fund, and just leaving it there, I mean, you saw like going from 1,000 to 1,100 isn't going to change your life. It's a free $100, but that 10% rate of return, which is about the it's what's called the compound annual growth rate over the last 100 years of the stock market. If you put $250 a month away over the course of 40 years, that's over $1 million. And if you want to get there faster, you put more than $250 in.
Yes, sir. And you talked about some of your classic reads. I read, so I'm an auditor by trade, so I always got to follow the data. I don't feel comfortable just, I guess, acting on my own, taking a lot of risks. And so I read 15 personal finance books. My top two favorite right now are The Millionaire Next Door, because that's a book that my father gave me in high school.
Love it.
So I kind of just have some emotional attachment to it. But my new favorite book is A Simple Path to Wealth. Do you have a book that you would recommend for people to read?
Those are two of my favorite ones too. I have a reading list on my website. I actually, thankfully, read The Simple Path to Wealth relatively recently, and I say thankfully because if I had read it like years ago, I would have felt like a total fraud, because he basically says the exact same thing I say, and it makes sense because we're both big fans of Jack Bogle, who is the founder of Vanguard. And yeah, those I think those are two really good ones, because The Millionaire Next Door talks about being frugal and living below your means, and how like I'm a millionaire, I drive a 2016 Mazda. It's not about like showing your wealth. It's about like spending less and investing to actually like have wealth and not like look wealthy. Another one that I think anything by Jack Bogle, like the little book of Common Sense Investing, which basically talks about index funds. There's one that I like. It's called A Beginner's Guide to Investing, which is like 100-page. It's kind of like the cliff notes of all the classics. I like A Random Walk Down Wall Street. All of these say the same thing, which is anytime people start to want to be smart and like try to pick and choose stocks or day trade or like get into some like more like speculative form of gambling in the market, it's not good. It's not likely to have you beat the market. It's more likely to have you lose the market.
And you had another post to the people who are listening still unconvinced, I guess, and they're like, well, I can just put it in my savings account. You have here, your savings account is costing you $2 million. So explain.
Yeah. I think one of my biggest pet peeves is when people ask me, like, what's a good high-yield savings account? And the answer right now is that there are no good ones because the interest rates are so low. But the real answer is you're hurting yourself by putting money there if you're not investing, because whether you get 0.1% like you get today or like 2% like you could have gotten a few years ago, what you really need is like 8 to 9 to 10% like you can get in the market. And so if you put $500 a month away over the course of your career over 40 years, if you put in a savings account getting a 2% rate of return, you end up with about $365,000, which is nice. It's good if it's better than zero. I'm glad you saved over the course of your career, but like not even really enough to retire on. If you put that in an index fund in the stock market over the last 40 years, you'd end up with over $3 million. So basically 9 times more money by investing rather than saving. And so, your story is a good one where people are like hesitant, there's so much uncertainty. How do I get started? What do I do? And so you're just saving. But that opportunity cost of not putting, your money into the market to actually build wealth is costing you $2 million over the course of your career, actually more than that.
Yeah, I appreciate you because for saying that. I don't think people talk about or think about the money they're losing by not investing as well. So even in that scenario, you said 9 times the wealth, I believe, if they invest in an index fund versus a savings account. Or even if they're just sitting on the savings account at the rates that they're at right now, they'd be losing to inflation. This year, they were lost about 3 to 4% with inflation at 5%. And I have, I'm using my air quotes for the people listening to the podcast, a high yield savings account. It started at 2%. I'd be surprised if it's at 0.9% now, because every time I get an email update and they read their terms, it's going down. And can you talk a little bit about, we'll transition, I guess, here to, you have your course, and it's, I believe compound interest is what you open up with as far as the modules. Can you talk about the power of compound interest? I think we've alluded to it here. So maybe a Webster's definition breakdown of what compound interest is and then why people should care.
So yeah, when you get interest, like let's say like your example, you put $1,000 in the market, and then a year later with a 10% rate of return, you have $1,100. That's a 10% interest. Compound interest is what basically happens the next year, because next year if you get another 10%, your $1,000 is going to make 10%, but your $100 is going to make 10%. And so you actually make more money. And so it's basically this snowball effect where your money keeps making you interest, but then your money that made money keeps making you interest. So if you invest on a regular basis, all the money you're investing every year from the first year to the current year is growing wealth, plus the interest is growing wealth. And it turns out over time, the biggest, when I said that $500 a month turns over $3 million, the biggest portion of that isn't what you saved. It's not even the interest on what you saved. It's the interest on the interest. And so that's like the magic of compound growth, and that's like the power of investing early and often. And it's a tough sell, and I want to get people excited about because it's like what really will make you rich, but it takes time. It doesn't in the first year, and even the first 5 years aren't that interesting. You look, in your example, 1 year in, you're up $100. You're like, well, that didn't make me rich. But if you keep putting in that $1,000, you keep investing over time, then in 10 years, you're going to be like, oh, wait, it's 100,000. In 20 years, you're going to be like, oh, it's 600,000. Then it starts to get crazy.
Well, I'm a little bit different because I am an auditor. So I was actually very excited because I think it was, I don't even know why I was opening the account. I might have been prepared for this interview. And so I was like, so I haven't set up the automatic allocations because, like I said, I waited 2 years to open it up, just, paralysis by procrastination. And I was very happy with $100 because I have that high yield savings account. I can make like $24, and I have way more money in there. I think I have like $6,000 in there. And that's another thing. I have like 4 accounts. I have to have a spreadsheet for all the accounts I have because I try to have them dedicated to a specific purpose.
Yeah.
You talk about in your module 2 stocks and bonds. So what would they be expecting from module 2, and what do you cover in there?
Yeah, I think I like to just break things down to the very basic core unit. And I think when people hear stocks and bonds, it's like very abstract and what is it? And so I basically just go through and say, like, what is a stock? What is a bond? I think most people don't even know what a bond is. It's just like this very abstract concept. And a bond is when you basically loan money to a government or a company, and then they pay you interest as long as they have your money. And at the end of the term of this bond, every bond has like a term of time, they give you all your original money back. And so it's a way, and you get more than you get in a savings account, right? So it's a way to basically be getting interest and building wealth in a different way from a savings account and a different way from a stock. And a stock is basically a share of, I'm going to give away the whole course on this, which is totally fine because there's no secrets in the course, but like it's just like a more detailed breakdown. There's no secrets anywhere. It's like I give you the reading list, it's on my Instagram, it's all the same stuff. I'm just trying to get the word out. But yeah, stock is just a partial ownership in a company. We like break down that with examples, and we give like live demos of like how to actually buy a stock, stuff like that.
Well, don't worry, because when people don't pay, they don't pay attention. So this podcast is free, but hopefully they've got a notepad. They'll take action items from here. I want to deviate a little bit. Actually, I think it was my fiance that asked me about it because I hadn't heard about it in so long. Do you have anything that you can speak to about CDs? Are people still investing in CDs? I know they aren't getting the return that they used to. Have they gone the way of the dodo?
They still exist. I think if you walk into your local credit union, I think they're a little bit dangerous right now because if you walk into your credit union and you say, I want to open a Roth IRA, they might put you in CDs. And a CD is a certificate of deposit. It's similar to a bond where you put your money, except with a bond, you're kind of like loaning it. With a CD, you're like giving it to a bank like for a certain period of time in exchange for a certain rate. But yeah, those rates are essentially zero. And I would call them like negative rates because they're losing to inflation. And so, yeah, I'd say they're dangerous because I think people who don't understand how low those rates are and what the other options are could be hurting themselves by putting money there as opposed to a better investment.
And I'm going to skip around a little bit because, one, we're time sensitive here at #FinCon21. And I want to say, which source do you go to for the compound interest calculator? So I usually send people to investor.gov. Is that a source you use, or do you have something else that, either a free tool that folks can use to just kind of safely test these theories or concepts?
Yeah, that one's okay. I think there's if you Google compound growth calculator or whatever, I think there's a lot of them. The investor.gov one I think actually has a bug in it where like the numbers are slightly wrong. It's like close enough and it's all a projection anyway, so it doesn't matter. But I actually have one on my website that is like a little bit cooler because you can put how much money you plan to spend in retirement, and then you put in how much money you have now and how much you should contribute per month and your age and a few other details. And then it shows you like when you can actually retire, like when you hit your financial independence number. Then it's fun because you can play with those numbers. And I think it's pretty simple, but people can kind of like their eyes are open, like, oh wow, if I put in a couple $100 more a month, like I'll retire 4 years earlier, and like when you get excited about a week of PTO, think about 4 years of PTO, or think about 10 years of PTO if you get serious. Like that's pretty crazy way to change your life.
So go ahead and drop a hashtag the plug. What's the website where they can find the calculator?
Personalfinanceclub.com. You can click on tools in the top right and click calculator.